Welcome to this conference call to discuss the financial results for Mindtree for the fourth quarter and year ended March 31, 2018. I'm Sushant, Head of Investor Relations. On this call, we have with us senior management team, Krishna Kumar Natarajan, Executive Chairman, Rosto Ravanan, CEO and Managing Director, Parthasarathy NS, Executive Vice Chairman and CEO, Jagannathan Chakravarti, CFO, and Ramesh Gopalakrishnan, Chief Delivery Officer. The agenda for the session is as follows. Rosto and Jagan will begin with a brief overview of the company's performance, after which we'll open the floor for the Q&A session. Since we have introduced an audio webcast, some of you may join the webcast. The webcast is a listen-only mode, but you can post questions. We will take the webcast questions once we complete the questions through the conference call mode. Please note that this call is meant only for the analysts and investors. In case there's anyone from the media, request you to please disconnect as we just concluded the media briefing before this call. Before I hand over, let me begin with the safe harbor statement. During the course of the call, we could make forward-looking statements. These statements are considering the environment we see as of today and obviously carry a risk in terms of uncertainty because of which the actual results could be different. We do not undertake to update those statements periodically. I now pass it on to Rosto.
Thank you, Sushant. Good evening to all our friends in the investment community. Very happy to share with you that we ended the year on a strong note with revenues of $226.2 million in Q4, which works out to a QOQ growth of 5.5% and 15.6% YOY, making it the best quarter of FY18. On a constant currency basis, the QOQ growth was 4.5%. For the full year, we achieved $847 million in revenues, which is a growth of 8.6%, which again has exceeded the industry estimate for the fifth year in a row and continuously beats the industry growth rate in 9 out of the last 11 years since our IPO. Our continuing strategic investments in building expertise for domain, digital, and run are being clearly recognized by our customers. Some of the key highlights of FY18 are as follows. Our recently concluded customer satisfaction ratings are at an all-time high, and we set the benchmark in the industry on a few important parameters. This clearly demonstrates our successful delivery execution, and customers are looking to us to help them drive their technology roadmap, which shows the increasing trust and confidence that customers have in Mindtree. We achieved a trailing 12-month attrition rate of 12.5%, which is one of the lowest we have seen in the last few years, again reflecting our increased people engagement and high ability to attract and retain talent in Mindtree. We also had significant client wins in both run and grow side of the business. Many third-party advisories have positioned us in the leadership quadrant for both run and grow offerings. Automation is one of the important organizational priorities. This plays a significant role in modernizing our service delivery and enhancing efficiency for our clients. I'm proud to say that we are taking the lead in the industry to report the number of bots we have effective this quarter. We define bots as software that works autonomously along with humans, enabling Mindtree Minds to do more and accomplish larger goals. As of 31st March 2018, we have 335 bots operating in Mindtree. We continue to be very disciplined on our capital allocation, and like you would have seen earlier this year, we concluded our first buyback program, which was well appreciated by the investor community. We are also continuing to maintain a healthy dividend payout ratio. We continue this approach of enhancing stakeholder value through multiple mechanisms, keeping in mind the business needs, business performance, investments, and other strategic priorities. We fueled our leadership strengths to both internal and external hires, taking on higher responsibilities. Some other highlights for this quarter. Amongst verticals, travel and hospitality led the growth with 9.7% QOQ. Retail, CPG, and manufacturing grew 8.7%. Technology, Media and Services grew 8.2%. BFSI declined by 4% in this quarter, which was a one-off situation in this quarter, and we expect growth momentum to be back in the future. For the full year, all verticals had good all-round performance. Technology, Media and Services led with a growth of 10.8%. Travel and Hospitality grew by 10.1%. BFSI grew by 7.1%. Retail, CPG and Manufacturing grew by 6%. Amongst geographies, for the quarter, US grew by a healthy 7.5% and Europe grew by 6.2%. For the full year, US grew by 10.7% and Europe by 8.1%. Our digital business continues a strong traction with 8.3% growth QOQ, and full year growth again is much stronger than Mindtree, almost double of Mindtree at 18.9%. We have 338 active customers at the end of the quarter. We added 23 new clients in this quarter. Very happy to report that good improvement in all the client buckets, where $25 million customers grew by 1, taking the count to 4. $10 million clients grew by 2, taking the count to 17. $5 million clients grew by 1, taking the count to 38. And $1 million clients grew by 4, taking the count to 118. Trailing 12-month and quarterly annualized attrition are very healthy at 12.5 and 13.1 respectively. We ended the year with 17,723 Mindtree Minds, reflecting a gross addition of 1,102 people in the quarter. During the quarter, we had 339 campus minds join us. For the full year, we have added 1,285 campus graduates. This quarter saw some very strong multi-year, multi-million-dollar wins, and to share with you some examples. Mindtree was awarded its largest single contract to date by an existing customer in the airline industry in the U.S. Under this contract, Mindtree has been given full ownership of the QA function for this customer, and we are working with the client to radically redefine the QA function. For a partner and an existing customer in the enterprise software product segment, Mindtree extended its presence into the infrastructure management area with a differentiated value proposition and was awarded a multi-year, multi-million-dollar opportunity. We are providing cutting-edge analytics using SAP HANA to deliver customer insights for a large automotive company in the UK. Another existing airline client in the US has chosen Mindtree to be its strategic partner to support application development, maintenance, and quality assurance services as part of their IT transformation initiative. Coming to the outlook for next year, this quarter we signed deals worth $298 million, of which renewals were 256 and new contracts were 42. Contracts to be executed within 1 year was 237 million and greater than 1 year was 61 million. Digital contracts signed were 102 million. Overall, TCV signed in FY18 crossed 1 billion. We are very optimistic about the demand environment across all our chosen verticals and continue to see improvement in our win ratios. Overall pipeline has increased by 32% compared to FY17. Digital pipeline grew by a very healthy 66% compared to FY17. The further success and our large deal focus reflects the need for Global 2000 businesses to marry both scale and agility. Mindtree is in that sweet spot. Taking into consideration all the factors I mentioned above, we expect the financial year 19 to start on a very good note, and we expect to deliver stronger revenue growth in FY19 compared to FY18. With that, I pass on to Jagan to share some other financial highlights.
Thank you, Rostov. Good evening to all. In Q4, our fee revenue grew by 5.7%, volumes increased by 7.8%, and pricing realization declined by 2.1% due to higher number of days as compared to previous quarter. Overall, our pricing is stable. On consolidated basis, EBITDA margin are at 16.1% in Q4 compared to 15.1% in Q3. 70 basis point improvement was due to currency benefit and 30 basis point was due to operational improvement. EBITDA margin for the full year FY18 is at 13.6% as compared to 13.7% in FY17. On a constant currency, EBITDA margin for the full year FY18 would have been 15.4%. For the quarter, we have a forex gain of 2.9 million compared to forex loss of 1.3 million in the previous quarter. The ETR for the quarter was 27.3%, and the ETR for the full year is 23.2%. PAT margin for the quarter improved to 12.4% as compared to 10.3% in Q3, which is a quarter-on-quarter improvement of 27.9%. EPS for the quarter is 11.08, with a quarter-on-quarter growth of 28.7%. EPS for the full year is rupees 34.28, a good growth of 37.8% compared to FY17. Our DSO for this quarter, at the end of this quarter, was 67 days compared to 71 days last quarter. For the full year, FY18 cash conversion has been steady, with EBITDA to operating cash flow conversion at 76.2% and EBITDA to free cash flow at 62.4%. Our return on capital employed is at 26.6%. The Board of Directors at its meeting held on April 18, 2018, have declared an interim dividend of 20%, rupees 2 per share, and recommended a final dividend of 30%, rupees 3 per equity share, which is subject to shareholders' approval. Some points on margin outlook. As also mentioned, we expect revenue growth momentum to be stronger in FY19. With this, we are confident of improving the margin in FY19 as compared to FY18. Some of the key points to be considered are: in FY19, we have advanced the salary revision cycle to April 2018. All Mindtree mines will get their salary revision effective 1st April 2018. This will have an impact on the margins by 300 basis points. We plan to hire 1,900 campus graduates in FY19. We have applied for far less number of visas in FY19. ETR for FY19 would be in the range of 27 to 28%, a slight increase due to some of the facilities entering the 50% tax bracket. We expect this rate to continue for next few years, barring any new legislation that may impact the tax rate. With this, I conclude the update.
Aman, we can now open the floor for Q&A.
Sure, sir. Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. First question is on the line of Sandeep Shah from CIMB. Please go ahead.
Yeah, congrats to the management for a solid quarter and the execution. Just wanted to understand the growth within the top 2 to top 10 accounts in this quarter has not been as strong as we have seen in top accounts or non-top 10 accounts. So anything to call out, or is it more to do with seasonality? And Rosto, if you can give a color about any further client-specific issues within your top 10 or top 20 accounts.
I think our top 2 to 10 on a YOY basis, Q4 versus Q4 last year, is beginning to show very strong growth. For example, our second largest customer at the end of Q4 is a different customer than the customer we had in the past. So the churn, I think, is pretty much complete. Those customers with whom we had problems are either bottoming out, or they are continuing to grow. There's a turnaround in those accounts. So we are confident of improved performance in the number 2 to number 10 customers, as also the 11 to 30 customers as well going forward.
Okay. Okay. And also in terms of the banking and financial services, can you discuss what are the trends you are looking, especially in the North America?
Based on what we see at the moment, I think there should be a reason in the BFSI business next year, both in US and in Europe, which are our two primary geographies. However, we see much more opportunities for run-the-business kind of projects at this stage from our BFSI customers, and not that much of grow-the-business or digital kind of projects from our BFSI customers. Those that we have won recently, including some deals that we announced during the course of FY17 and recently in FY18, are continuing to ramp up and doing as well or better than planned.
Okay. Just bookkeeping question, Jagannath. In the cash flow conversion, if you look at for the full year, despite the margin increase, the net cash flow from operation has not been up to the mark. So what could be the reason, and is there any benchmark which you are looking in terms of a cash conversion, either as a EBITDA to operating cash flow or as a FCF to PAT?
Yeah, we continue to track the EBITDA to operating cash flow as well as EBITDA to free cash flow. We are also focusing on keep improving on the DSO. So there is no specific reason for the operating cash flows, outlook, whatever we have to tell for next year. It will be keep improving because all the collection metrics are doing well. Probably some amount of investment has come in on this cash flow. That's the reason why the cash from operation is slightly negative.
Okay. And about this reversal on the other income because of the Magnet 360 and the Bluefin, if you look at this year, that quantum at 91-92 crores has been almost like a 10-15% of the PBT. So how should we look that line item in the next year?
Nothing further will be there on this year. So this will actually, this is a process which has been agreed on the original acquisition contract. So based on that timeline defined in the contract, if the conditions are not met, the provisions are being reversed back.
So short answer is all the adjustments that need to be made are now complete. So no further charges or reversals in future.
Okay. Thanks, and all the best. I may come up in the follow-up. Thanks.
Sure. Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please limit a question to one per participant. If time permits, you may join the question queue for any follow-ups. Thank you. The next question is from the line of Apurva Prasad from HDFC Securities. Please go ahead.
Hi, good evening. Thanks for taking my question and congrats for strong growth. So my first question I had on your outlook on the top account. If you see growth has largely been skewed towards that, so if you can throw some light in terms of how you're seeing that going forward. And the second part is on margins. If you can talk about the levers from here.
So the large account that we are very proud of all the value we have created, great relationships, great name recall for Mindtree. Like I mentioned some time back, we had very strong CSAT scores in this year. The CSAT scores from our large customer was better than everybody else. So the best CSAT scores in Mindtree are from this large account that we've been servicing for a decade or so at the moment. So all parameters so far are doing quite well. We continue to still have an enormous amount of headroom to grow. So don't see any concerns at the moment. Nonetheless, the increasing customer concentration is something that we are very mindful of, and the solution for that will be to push the pedal and do more with the remaining accounts that we have, especially the number 2 to number 10 customers, and maybe even the number 11 to number 20 customers. So we are doing a lot more to move the needle on those while continuing to make sure that everything goes well with our large customers also. On the margin question, I think at this point of time, some of the key operational parameters like utilization have reached reasonable amount of comfort level for us. We continue to keep pushing. I think the revenue growth will probably be one very big margin lever you can see even during the course of this year, quarters where we had very strong revenue growth are almost directly correlated to margin improvement as well. So strong revenue growth is one margin lever, and I would say the second best would be to improve the performance of both the package solutions business that we now rebranded as Bluefin and the Salesforce practice, which is now rebranded as Magnet 360. Strong and stable performance on both of those should also help us get better margins in FY19.
Right. Thanks and all the best.
Thank you.
Thank you. The next question is on the line of Madhu Babu from Prabhudas Lilladher. Please go ahead.
Hi, sir. Congrats on a good quarter. So how is the velocity of conversion of the deals? And so are we the anchor partner in most of the digital deals which we have won?
Deal momentum continues to be very strong. Pipeline is building up, so there's no softness in the demand environment across the board there. And Mindtree's win ratios are improving. So I think overall we are very pleased with what we are doing on that front. So don't see any concerns there.
And sir, in good, I mean like in 2Q FY16 we delivered almost 8% organic growth quarter on quarter. So considering the macro is good, so do we expect such swing quarters in 1H of FY19? And when we are saying margins will drop 300 basis points quarter on quarter in 1Q, I mean because of wage hikes, are we having any counter effects which will negate the impact of wage hike? Thanks.
Going back to the previous question, for digital, yes, we are continuing to be seen by many of our clients as their anchor partner for their digital transformation initiatives. Coming to the question on margin, yes, Q1, we will see how the quarter goes in terms of revenue performance and in terms of other things as well. Hopefully, a few other things will help us offset the pressure that will come because of wage hikes. But nonetheless, on a full year basis, I think the margins in FY19 should be higher than the margins in FY18.
Okay, but we expect 1H to be very strong, 1Q or 2Q, first 2 quarters.
The year is starting off on a very strong note.
Okay, sir, thanks.
Thank you. The next question is from the line of Gaurav Rateria from Morgan Stanley. Please go ahead.
Hey, congratulations on a magical performance, Rosto. Question on digital. I've seen the digital revenue growth accelerating to 25 to 30% in the last 2 quarters. Is this purely a base effect, or do you think some trends are changing in terms of deal sizes and engagement levels because of which the overall digital revenue can actually accelerate compared to the levels it has been going in the last 2 years?
Thanks, Gaurav. I would, on a lighter vein, say there was nothing magical about it. It took a lot of hard work by a whole bunch of 17,000 Mindtree minds. And like we explained in this in our earnings release, the 330 bots that we have all combined together to produce that result. But on a more serious note, on digital, continuing to see very strong traction amongst 3 of our verticals. Technology, travel, and retail CPG manufacturing. Some of the work we are doing there are path-breaking for their respective industries. Overall, we are seeing number of deals and size of deals going up. So today, we are having quite a few $5 million, $10 million kind of deals in digital. I would say the strongest traction are around helping our customers with their cloud and analytics journeys. So those are the best sweet spots for us at the moment. It's also a very strong recognition from many of our partners on the cloud side. Very strong partnership with both AWS and Azure, content management with Adobe. So across all our partners, we're getting very strong recognition for the work that we are doing. So that's what we are seeing on the digital side.
Sure, thanks. Question on margins for Jagan. The 1Q will see confluence of 2-3 factors. One is the wage hike, which you quantified as 300 basis point, and then possibly increase in the travel cost because of visa-related expenses. What are the offsetting factors, and do you think you can absorb the margin and still hold on to the margins at the current levels? Thank you.
to, it may not be able to, we may not be able to completely observe the impact of the salary increase, but there will definitely be some amount of operational improvement going forward.
Thank you. Roster, just wanted to also clarify that, like Jagan mentioned when he made his comments, we have significantly ramped up our ability to hire both campus graduates as well as laterals in all our key markets. So in Q1, we are not expecting a big swing on visa costs. Unlike in previous quarters, Q1 will not see a big swing on visa costs. So the main margin headwind for Q1 will be the salary revisions only.
Okay, thank you.
Thank you. The next question is from the line of Pankaj Kapoor from JM Financial. Please go ahead.
Yeah, hi, thanks for the opportunity and congratulations on a good quarter. Rostov, I think we entered the quarter with about 3 to 4% kind of a growth expectation. So did this acceleration in the growth that you saw during the quarter, was that a surprise? And if so, what led to this acceleration?
No, I wouldn't say it was a surprise. I think we were quite confident of the growth in this quarter, and largely it spanned in line with our expectations.
Okay. And if I look at the top account, what kind of a visibility do you typically have there? I mean, I'm presuming these would be typically short to medium-term projects. So is my understanding right, or this is something which has got a long-term commitment of revenues also over there?
Contrary to what you said, the bulk of our business is multi-year kind of contract. So there's a reasonable amount of visibility. So quite confident of next year's growth projection from this account.
Sure, got it. And just lastly, on the margin outlook, if you're looking at the first quarter margin decline, going forward from second quarter onwards, do you expect a bulk of impact on the positive side should be coming in from utilization, or you think it will be largely because of our increased campus hiring, the pyramid impact will be a bigger margin driver for us?
Like I think Jagan briefly mentioned in his comments, I think utilization is already at 75% or so. So unlikely that utilization will be a bigger improvement or a bigger factor in margin improvement for next year. I would say the revenue growth will probably be the most important driver for us from where we are at the moment. There will obviously some amount of continuous improvements will drive from an operational efficiency perspective, but revenue growth will probably be the biggest margin driver for us next year.
Got it. Thank you and all the best.
Thank you. The next question is from the line of Ashish Chopra from Motilal Oswal Securities Limited. Please go ahead.
Yeah, hi. Thanks for the opportunity and congratulations on a good quarter. Rostov, I just wanted to pose the margin question a bit differently. So I think on a full year basis, the 13% margin in FY18 is obviously a slightly easier compare, especially if I consider the exit margin of 16.1%. So I just wanted to understand that, given that you start at a lower base quarter on quarter, how do you feel about your ability to end up on the margins front next year or maybe in a couple of years' time compared to the exit margin of 16%? Or do you think that, a margin of at this level is probably a quarterly number given the seasonality, and on a full year basis one should probably expect a number in the band between the full year average versus the exit margin that you have?
I understand your question, Ashish, but clearly, our policy should not give guidance. At this point of time, I would say, if you look at the full year this year compared to full year FY17, there's a 200 basis points impact because of currency, negative impact because of currency, and in spite of that, we have improved margins. So all the effort that we put in terms of operational efficiency, bringing the sales force and the SAP practices back to stability and very strong growth in both of them in this quarter, 7-8% kind of growth in both those businesses in this quarter, etc. All of which have led to the improvement during the course of this year. And we are confident that many of them will continue to give us benefit next year. But nonetheless, for me and for the entire management team, this continues to be a very important priority that we want to continue to push for margin improvement next year. We still don't feel confident about it. We still don't feel good about the margins where we are. So there's a big push to help improve margins as we go forward.
Okay. And secondly, just for a bookkeeping question, could you help me with the revenues and profitability in Bluefin and Magnet 360?
We don't report either of that separately. In any case, the entire package solutions business has all been amalgamated into one group. Bluefin doesn't exist as a separate legal entity anymore. And even with Magnet, now there's reasonably large amounts of Salesforce practice revenue now getting booked in Mindtree from our existing customers. So looking at it individually probably will become lesser and lesser relevant going forward.
Sure, but would the juice on profitability improvement from these entities still be significant, or you would have largely turned them around to the levels that you would have wanted to?
I think in Q4 we brought them to a reasonably decent state, but I think some further work is required to bring them to our comfort levels.
Got it. That's it from my side. Thanks and all the best.
Thanks, Ashish.
Thank you. The next question is from the line of Dipesh Mehta from SBI Cap Securities. Please go ahead.
Yeah, thanks for the opportunity. Just want to get sense about BFSI. I think you alluded to one of the factor which impacted performance. So if you can help us understand a bit more about quarterly what played out and how you expect it to play out over next year. Second question is about the rest of world. If we look, there is some kind of weakness. Is it because of some reclassification, or despite that weakness we are seeing this strong growth? So if you can help us understand, outside of that particular weakness, growth seems to be very strong. So if you can address these two things. And then I have follow-up about, usually we used to provide next quarter kind of outlook. So if you can help us understand how you expect Q1 to play out. Thanks.
Okay. On BFSI, it was client-specific issues for one of our customers where a project ended and we still haven't been able to identify and start some new work there. But over the last 2 or 3 quarters, many new customers have been added which are growing extremely well. So to that extent, it was client-specific issues with 1 or 2 customers, and we expect BFSI business to do well next quarter onwards. Pipeline continues to be strong, and ramp-up, etc., in the previous wins that we had during the course of this year and last year continue to be strong. So we expect BFSI to start showing better performance from next quarter onwards. I'm not sure if I fully followed your other question on margins, etc. If you could repeat that once again.
Yes. The second question was about rest of world. If we look from the geographical mix perspective, we are seeing some weakness in rest of world. Is it because of reclassification? And if it is not because of reclassification, the rest of the business is showing very strong momentum. So do you expect that momentum to continue going into next quarter?
I don't think there was any significant reclassification in this quarter on the geographic revenue. Across all the 3 parts of our business, Europe, US, and the rest of the world, seeing good traction across all of them. For example, the win that we had in this quarter of the enterprise product company was with the Asian business of this particular customer. So seeing good momentum across all the 3 geographies. But nonetheless, I would say the US and Europe are both our largest market segments and also will grow faster.
Sure. Rosto, rest of world seems to have declined 20% this quarter on quarter, and even for the full year, it seems to be declining around 11%.
Again, just anecdotal factors.
Okay. So not much to read kind of thing.
Yeah, but overall it's maybe whatever 5-6% of our revenue, so even a 20% decline on it doesn't sort of make that much of an impact at all.
I agree. My point was different. If, let's say, despite that weakness, we are seeing very strong momentum, and that's what I wanted to understand. Okay, broadly, you are suggesting US-Europe is very strong.
That's right.
Understand. And the last question is about if you can help us understand Q1, how we expect momentum to play out.
Not commenting, like I said, in terms of guidance for the future, but we're expecting the year as a whole to be better than FY18 on growth, and the growth will start from Q1 onwards. In the sense, it is not a back-ended growth year. We're expecting the momentum to be reasonably even across all the 4 quarters. We're starting the year on a strong note.
Okay. Thank you.
Thank you. The next question is from the line of Abhishek Bhandari from Macquarie. Please go ahead.
Yeah, good evening to the whole team, and congratulations on very good hard work. Rostov, I had one question. Now that a good part of FY18 was spent on stabilizing some of the problem areas like working on margin and getting some of the weakness from clients done, and the outlook for FY19 is strong on revenue growth and improving margins, do you think we are going to again look at stepping up our pedal on the M&A activity?
Not at the moment. I think given the momentum that we have and given our own analysis of the portfolio, don't see any immediate plans to look at any M&A at this moment. If something evolves, then obviously we'll keep the investment community updated at that stage. But at this moment, not seeing any M&A plans in the near-term future.
Okay. Thank you. Thank you and all the best.
Thank you, Abhishek.
Thank you. Before we move to the next question, I'd like to remind our participants, limit a question to 1 per participant. Thank you. The next question is from the line of Rahul Jain from MK Global. Please go ahead.
Yeah, congratulations on strong number. Couple of things when we are talking positive view on FY19 from a revenue perspective, how you would say this is more driven by the performance which company is making as in from a market share win perspective, or we are also getting a positive pushback because there is a general improvement in the environment from a spending perspective?
Rahul, on a lighter vein, I've never heard positive pushback in a conversation before, but jokes apart, I think we are seeing 2 or 3 factors. One is overall, customers are now beginning to make much larger bets on transformational technology initiatives. Technology today has clearly proven that it can make a big difference to the front office function and therefore can contribute to revenue growth. So there's a change in the mindset of the customer and therefore some of these digital kind of programs are becoming more larger and enterprise-wide. So there is increase in technology spend on some of these kind of programs. Secondly, people like successful organizations, specialized organizations like us, have gone and disrupted the customers' run the business portfolio with enormous amount of automation, use of tools, etc., that have given higher efficiency and more predictable cost reductions for our customers. So we are actually winning more volumes from majority of our customers on run the business portfolio. So even in segments like that, where the customer spend is declining, we are able to get a higher share of the volumes. Finally, I think there is an, improved sentiment in the marketplace by customers on their own business, and that confidence is also reflecting in the kind of projects they are starting, the kind of budget approvals they are giving to their businesses, etc. So we're seeing a combination of all of these 3 factors. But I think the underlying sort of strength for Mindtree is the call that we took about 4 or 5 years back, where we called out digital as a trend, made all the investments behind both domain, digital and run, are now beginning to yield results for us.
Okay, and so in one of our largest account, or the top account, we have seen significant growth in this year. So is there a project kind of a nature to it which can still be repeat because there are transformation which is undergone? And otherwise, or you can say this is more on the run side of the business.
For our largest customer, we work with them across multiple service lines. So there are things that we are doing for them on analytics, etc., and also doing, helping them with their run the business kind of infrastructure management, application support. So it's a multi-service line penetration into that account. Great customer satisfaction, great value creation for this customer, like I outlined before. So continue to see strong traction.
Okay, and lastly...
Mr. Jain, sorry to interrupt you. Maybe we could join the question queue as we have several participants waiting for their turn. Thank you. The next question is on the line of Abhishek from Equirus Securities. Please go ahead.
Hi, sir. Thanks for the opportunity and congrats on a great set of numbers. The question is regarding the growth in FY19. The exit rate... leads to almost 6.5-7% growth on a YOY basis. So what is, leading to this, conservative kind of a guidance or, saying that, that our numbers will be better than FY18, which is just 8% and 7% is on the exit rate. So are there any risks that are, you are, factoring to keep it conservative or, anything else, which is keeping the guidance conservative?
No, nothing other than systemic or macro kind of risks that all of us worry about. Nothing is holding us back right now. I wouldn't at this stage call our guidance either conservative or aggressive or anything or the other because we don't give guidance. We just made a qualitative comment that next year's growth will be better.
Okay, and just a second one on the margins. This year you did almost 1,300 people on fresher hires. Next year also you are guiding for a stronger number. Could you just highlight, what is the 0 to 3 year band today for us, and can that be a margin lever next year? I know you've answered this, but if you can also highlight where the pyramid is, that will be helpful. Thank you.
My colleague Sushant will answer this question.
Yeah, hi. Currently the 0 to 3 year band at the Mindtree level is close to about 27%. So obviously there is some scope for improving there, and we'll report that as we go along.
Thank you for taking my question, sir.
Thank you. The next question is from the line of Sangam Iyer from Shipcom Ventures. Please go ahead.
Yeah, hi. Congratulations to the Mindtree team for a great set of numbers. I just wanted a small clarification. It's kind of a follow-up from what Kaya asked earlier. Is that in terms of the margins that we say that it's going to be better than what we have reported, are we adhering to Q4 numbers or are we adhering to the full year average? If it's Q4, could you just elaborate a little more in terms of what are the margin levers that we are looking at for improvement in margins beyond 16%?
The short answer, Sangam, is that the comment was around full year margin. So we ended the year at a certain margin profile. So the focus would be to continue to deliver better than that next year. Growth momentum and some amount of continuous push out operations, cost control, etc. is what will help us get there.
Got it. So, sir, just a small follow-up to that is that in terms of margin levers, we did mention that utilization is more or less at the kind of a peak level where you'd want it to be. So it's predominantly going to be driven by growth that would come back next financial year. Is that the right way to look at it?
Growth will be one big contributor. Improving the steadiness and continuous growth in both our package solutions as well as our sales growth practice will be another one. Pyramid will be the third from an operational perspective.
Got it. Great, sir. All the best.
Thank you. With the next question from the line of Nitin Padmanabhan from Investec. Please go ahead.
Hey, hi. Thanks for taking my question. Rostov, historically you've been a little more specific on guidance in terms of, let's say, high single-digit growth or mid-double-digit growth. This time around, you have said that it's going to be better than this, last year. So I was just wondering, is it because 45% of revenues is digital, so it's difficult to really, pin that visibility to the later half of the year considering their short cycle projects? Is that the reason, or is it just being conservative?
Again, if I give you the impression that I was being conservative, then I think my apologies, and we want to reconfirm that we are not being conservative. We are just sticking to our philosophy of not giving guidance. All we said was next year will be good, and the growth momentum will continue from Q1 onwards. So it is not a back-ended kind of a growth. The year is starting on a very strong note. So that's where we'd like to leave that.
Sure. I just one more, if I may. This time around, if you look at the new deal wins, it's 31% lower than than the last year, but still our outlook is actually better. So is it fair to assume that on the renewals there's incrementally more business and thereby that's leading to a higher growth? Is that how one should look at it?
Not exactly. If you look at the rhythm of our business, more than 90% of our growth comes from existing customers. So that usually new customers contribute about 5-6% of your of the revenue for the year. So continuous focus on mining existing customers will always lead to more growth coming out of existing contracts.
Sure, fair enough. Thank you so much, and all the best.
Thank you.
Thank you. The next question is from the line of Kawaljeet Saluja from Kotak Securities. Please go ahead.
Hey, hi, Rosal sir. Congrats on a great quarter. Just a question. I think in the quarter there has been quite a bit of changes to the board. Now I understand that you have already announced the stepping down of Vijay Siddharth from the board, but there are a couple of other changes as well. Just curious to know the reason for the same.
Hey, Kawaljeet, all three members of the board who stepped down were in some senses, based on their own, two were, based on their preoccupation in their own businesses, and Pankaj Chandra, who completed his term on 31st March 2018, so therefore he just, did not seek reappointment. Vijay Siddharth, primarily because of the growth of his own business, Coffee Day business is so strong that he needed time to focus on it. Continues to be a very strong supporter of Mindtree. No changes to any strategy or plans or anything or the other. Similarly, Manisha as well has come almost to the end of her tenure from her board appointment, and given her priorities in the way her own business is growing, decided to focus on that than to seek reappointment. So it is just individual decisions by those board members. No negativity or Mindtree in any form or fashion, and at least with respect to Siddharth, who's also our largest shareholder, no change in their priorities or no change in their evaluation of Mindtree. So all of them continue to be great friends and continue to be extremely supportive of Mindtree.
Right. And what's the composition of board now between independent and otherwise? What's the composition look like after these changes?
Just before I answer that, I just want to complete the previous answer. We also announced today the addition of Biju Kurian to our board as an independent director. Since he's joining as an independent director, this requires shareholder approval. So the appointment will be effective after the AGM, which is on 17th of July. So it's not only the three who have either retired or stepped down, but it's also the addition that we wanted to share. Post Biju's joining the board, it will be 4 independent and 4 non-independent directors. So it will be an 8-member board. As we continue to look at our future priorities, the board the nominations committee has a clear strategy in terms of competencies that we'd like to see in our board, and we'll make additions as the year progresses.
Got it. And also, the second question is just a little bit curious as to what does the disclosure of bots mean? Is it Mindtree's own bots deployed on client servers, or is this just bots which includes implementation of robotic process automation of a third party a provider like Blue Prism or Automation Anywhere or, whoever the players are in the market. What does this metric stand for and how should I interpret this?
So the reason we included that is to reflect the changes that are happening in our industry and the primary sort of messages that we wanted to share with you was, one, we have a workforce that now includes both humans and non-humans. Secondly, we wanted to reiterate that factors like automation are not leading to job losses, etc. So our own experience in wherever we have done bots and delivered services to our clients through bots have led to the repetitive, mundane kind of work now being handled by the software bots, which is leading to the human workforce becoming more engaged with more value-added, higher, cerebral kind of tasks, and also that bandwidth getting freed up is helping people, get reskilled, etc. So again, as an anecdotal example where we have, seen this impact, people satisfaction scores by those projects have actually significantly increased. Coming back to the point that this repetitive, mundane kind of work is getting lower. It's also leading to, for example, lower attrition in the project because now those people are able to go spend more time on getting reskilled, etc., etc. So the point was to reflect the trend that we are seeing from a people dynamics and a technology dynamic point of view. These are the bots that we have developed either as ground-up developed code by Mindtree or through bots that we have worked with third-party partners like Automation Anywhere, etc. But these are bots that are currently running by Mindtree for servicing our existing customer needs. This is not and gave it to a customer, but these are actually being used day in and day out for service delivery by Mindtree. The last message we wanted to also share is as this becomes larger and more material, this should also become an important margin defense lever for us, especially in run-the-business projects where there is continuous amount of customer expectations on cost reduction. So you want to start tracking it, and to some extent that will also start reflecting as it becomes more material, start reflecting as a margin defense lever for us.
Right. I mean, just an observation, Russell, sir. Let's say if you implement a bot of a Blue Prism or Automation Anywhere for a client, I mean, once the implementation is done, you collect the implementation fee. The subsequent collection of revenue is minimal, and the entire license, so to say, effectively, or a recurring revenue gets taken away by the RPA provider. So I don't know how this metric will help me, in any way build a definable revenue forecast, or how should I really interpret this metric? Maybe I'll take this offline, but just a thought.
But quick response, and maybe it requires a longer conversation. And you're right, if the revenue model was pure T&M, then after the initial implementation, there's no follow-on revenue. But if Mindtree had ownership for a defined deliverable, for example, if Mindtree had ownership in an infrastructure management project for a system uptime, etc., and then I'm delivering it through bots and therefore not having recurring human workforce wages, then that's how we get to see the benefit of margin improvement over time in those kind of projects. And our kind of revenues is increasingly moving to that. If you look at the fixed price, monthly kind of contracts in this quarter, it's gone up over the previous quarter. So as we take more and more ownership for deliverables, and then we deploy, and then we do it through reusable components like bots, that's how we begin to see the benefit from a margin improvement perspective.
Got it. Thank you.
Thank you. The next question is from the line of Viju George from JP Morgan. Please go ahead.
Yeah, thank you for taking my question. Congratulations to the management team on a very strong quarter. Rostov, my question really relates to industrialization of digital. Are you seeing very irreversible signs of this? How strong is this theme picking up? Can you give us some indications of how large the contracts are getting? What is the offshore centricity in such contracts? And then I have a follow-up question.
Hey, Viju, good to hear from you. Overall, yes, we are beginning to see digital becoming more larger, more complex, and more transformative. So it's becoming multi-geography or front to back within a business unit or multi-brand, etc. So overall size of digital deals is growing. What is especially sort of exciting for us is Mindtree's win ratio for those deals, including those opportunities where we go head-on against some of the largest players in the market there. We're still able to, get almost like a 50% plus kind of a win ratio for the large kind of transformative digital deals. Today we have a reasonable number of 5 million plus, reasonable number of 10 million plus kind of opportunities in digital within our pipeline, and continue to see more of those being created, in many cases incubated by Mindtree, meaning Mindtree went to their existing or a new customer and created that value proposition and created that need in the mind of the customer, and not responding only to RFPs. So the true consulting-led kind of an approach, all of those sort of very strong momentum, very strong sort of factors reflecting our very, very good story on digital with customers within our 4 verticals.
So how do you see do you think in the larger digital deals, how do you see the needle on the on-site offshore ratio moving towards offshore? Are you seeing a situation where substantially more of that business can be done offshore, and how do you see this going forward?
Absolutely. So the larger digital programs do have a very strong offshore component. For example, on our largest digital opportunity, which is, I would say, in the $15 to $20 million kind of a range, typically operates almost like, maybe 75-80% offshore by effort, and maybe 20-odd% on-site. So the larger programs do lend themselves to much higher amount of engineering kind of activities, and a large part of it can then move offshore.
Sure. And my second question really is that if you see this theme picking up currency, and it is an inflection point, maybe not 2018, maybe 19 or 20, I know you have alluded to the fact that your win rates in these kind of deals against tier 1 players is very good. But do you sense that with these deals getting larger and more complex and getting more offshore-centric with multiple technologies, do you think the advantage might shift back to the tier 1 players who can bring these complex integration skills together to a table in one platform? And maybe, I'm not talking specifically about Mindtree here, but you can generalize this, maybe some of the mid-tier companies who've been working with slightly smaller projects, maybe a couple of technologies, for instance, may find themselves out if this tide takes over.
Interesting question, Viju, and frankly, I'm not sure if I would have enough of a meaningful answer for you. The only thing I am confident of is that our story for those deals are very, very strong. In more than one case, like I said, we are seeing larger number of deals. Customers are clearly making big bets behind those kind of things. So there's no softness in demand. There's no very active demand for those kind of opportunities, whether it is customer feedback, whether it is feedback about Mindtree by the industry analysts. From all of those parameters, I think we are in a sweet spot. We have both the ability to scale as well as the agility to deliver results there. And the other thing that we are seeing slightly different from the implication that you raised in your question is that this doesn't require scaled talent. Even large programs still require very high expertise but small number of teams. So for Mindtree, at least, we don't see ourselves being at a disadvantage compared to the large guys. These kind of deals make the customer look for specialization than scale. So it's actually working to our sweet spot.
Sure, thanks. And one last question is that your productivity has been improving, that is realized rate. How much of this due to fixed price productivity improving versus better contracts or better mix? Better higher contribution of digital, that is better coupon rates or better mix. And do you think this upward trajectory can be sustained?
It is all of those, including, I would say, very strong and successful delivery. That also led to the improved revenue productivity. We still think there's a lot more that we can do. So I don't have a specific answer that where it will go up by 1%, 2%, 1 quarter, 2 quarters. But I think there's still a lot of momentum left on that theme, and we continue to do more, or we need to do more.
So safe to say that your revenue growth will be higher than your volume growth.
Yes.
Okay.
Number one. And number two, that plus other factors should lead to higher margin growth than revenue growth. So EPS growth or PAT growth, for example, will be faster than revenue growth.
Sure. Sure. Thank you and all the best for FY19.
Thank you. The next question is from the line of Ruchi Burde from BOB Capital. Please go ahead.
First of all, congratulations to the management for the stellar quarter. I wanted to ask you more about the BFSI comment that you made. You commented that the demand is optimistic and more so you see more demand on the run the business side. Could you talk a bit more about what is driving this? Is it more differentiated solution that Mindtree is putting across? And what are the reason you see the digital demand being little slow or the change the business demand being a bit slow in BFSI?
I think the many reasons, quite possibly that BFSI is much more regulated, etc., and therefore the customers probably spending a lot more focus on their regulatory requirements and some of those kind of things. And typically we've also, even in the past technology cycles, we see industries like retail being early adopter of new technologies and industries like BFSI tending to be later adopter of technology. So it could just be the mindset of customers between different industries there. On our win rate, on our success rates in the Run the Business program, I think all the effort we put in from building platforms which are able to give customer more confidence on our ability to predictably give them quality improvements, efficiency improvements, year-over-year productivity improvements, etc. I think that's one of the reasons that we have good success rates there. And I would again come back to that point on strong delivery. Many customers, we have great referenceable case studies, and therefore either for additional opportunities in an existing customer or for a new customer, internal references or references from their comparable companies is also a reason why we have that. But I think strong delivery and the focused effort to building platforms are a very big part of the reason for our success.
Secondly, could you sum up for us what progress we made in terms of our turnaround effort for Bluefin and Magnet 316 FY18, and what are the areas or challenges we plan to address in FY19 in this part of the business?
I think the focus was primarily around getting them to stable revenues because we saw very high volatility quarter to quarter in that business. So a lot of effort went behind chasing different kind of deals, working with a different set of channel partners, etc. And also reorienting the sales teams, reorienting the geography priority in some of those units, etc. All of which contributed to help stabilize the business both on revenue and margins in Bluefin and Magnet during FY18. All of those activities will continue to apply in FY19 as well. While we feel a little relieved with where we have reached, we recognize that there more work needs to be done on both those businesses, and we are continuing to stay focused on it to help get it to a better place.
Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Sushant Pai for closing comments. Thank you, and over to you, sir.
Thanks, Aman. Thank you all for joining this call. We look forward to staying in touch, and if you have any specific questions, please do get in touch with us. Thank you once again.
Thank you very much. Ladies and gentlemen,